If you take your money and take it to Vegas and put it on black and lose, that's still a better use, in my opinion, than handing it over to the government. That's the goal, is to keep money in your pocket and not in the government's.
Taxes is something we all have to deal with. There's no getting around it. You cannot escape it unless you know exactly what to do. And if you're not aware of it, it's going to eat you alive.
I've been a strict W-2 earner, and there's absolutely nothing you can do. You're going to be taxed at the highest rate possible as a W-2 earner. I don't think a lot of people even think about what that means.
If there's any principle at all in taxation, the guiding principle for business is that
Welcome everybody back to the best podcast on the net, Remnant Finance. We're once again welcoming, for the second time, our first repeat interview, I believe, our good friend Neil McSpadden with Tax Sherpa. He's been representing us for a couple of years. Neil we talked about his background on the last one, but just a quick recap. He had a background where his story, I'll let you tell your story, Neil, of how you got started, actually, because you can do it just as better than I can, even though I've heard it 10 times.
Yeah, it's a story that is not too uncommon for many entrepreneurial types, where you go a few years and suddenly you start getting nasty letters from the IRS. So my nasty letters said I owed them about a little over $1.3 million. And this was back in 2007. This started. And that was the beginning of my tax journey. So like most people, I ignored those letters. which is not what I officially recommend doing these days, but that's what I did. I ignored them. So I went through that whole process. First you get letters, and then after a while they start sending you certified mail. We have to sign for them. And if you ignore those, you'll start getting phone calls. And if you ignore those, then they'll just go after whatever they can find. And in my case, at that time, so that whole process takes like 2 years. In my case, by about 2009, they started garnishing my paycheck. I was tutoring high school kids at the time. And I went from making peanuts to making nothing because they were taking all my income. And so that really got my attention, as you might expect. And then I started looking around for someone that could help me fix my problems. And I found a guy who used to be a Wall Street tax attorney and had gone out into his own private practice. And he helped me fix my problem. And in that whole process, the reason I'd gotten into trouble was because I was doing entrepreneurial type things. I was trying to find my way after deciding not to become an engineer in the corporate world after some early experiences, deciding that wasn't for me. And so, by that point, I had about a decade worth of School of Hard Knocks, learning business and marketing and all the things that go into, trying to make money beyond just working for somebody else. When I started fixing my own tax problem, I saw his business, and he was growing at the time, but had no business skills really. And so we ended up, basically partnering up. I helped him with business operations. He helped me with my tax problems, and then ended up teaching me the tax game from this perspective that I didn't know at the time was very different. He was always focused on planning first and saying, okay, given the client situation, what can we do? What options do we have available? If we do X, Y, and Z, we end up with this different result rather than just taking whatever they have and putting it in the computer, which is what most tax professionals do. So that really set me down a path of very planning focused approach in the tax world. And I worked with him for about a decade and then decided to go off on my own back in 2019 and really started in 2020. And then I don't know if you remember, but the whole world shut down. there was this thing that, maybe we don't say the name of on YouTube still. I don't know what the current rules are, but, Tax Sherpa went into 2020 and, the plan had always been to be remote, and we ended up being forced to be remote anyway. So that kind of worked out. We went through that whole time. And then in November of last year, I actually bought an office here locally. I'm in the Atlanta area. And so, we acquired a book of business, and now I'm back in the office helping clients. And some people come in person, but most people are still remote these days. So that's kind of the journey. Over the years, worked on over 50,000 tax returns and helped, save hundreds of millions of dollars worth of taxes. So that's the goal, is to keep money in your pocket and not in the government's.
Because we will be better stewards of it. Even if we're poor stewards of it, we'll probably be better stewards of it than the government will.
So for me, and this gets down to like hardcore philosophical outlook. For me, if you take your money and take it to Vegas and put it on black and lose, that's still a better use, in my opinion, than handing it over to the government.
If we think about taxes is something we all have to deal with, right? There's no getting around it. There is a web of code and taxation on everything you do repeatedly, the same dollar in your life coming in, going out, being taxed over and over and over and over and over. When you die, being taxed. When there's so much in the tax code, you cannot escape it unless you know exactly what to do. The tax code is a roadmap. I just grabbed my copy of the tax code, and if you're watching, you can see it's really thick. And I've put a little paper section in the part that defines income. The rest is how to not pay it, essentially. So there is a roadmap here, and there's a way that you can get out of there, but you need someone like a Sherpa, tax Sherpa. It's like if everyone is required to climb Mount Everest, you don't have a choice. You have to climb it, and you might just die on the way. Like, would you rather increase your odds of getting there having someone who knows the lay of the land, knows exactly what to do? We can't be experts in this and do our regular job, but you ought to have someone on your team who knows this stuff inside and out. Because if you're not attentive to exactly what your exemptions are, what income you're making, how to find these carve outs, if you're not very well versed in that, you're going to get eaten alive.
Yeah, that's for sure. Every tax season, I see people online talking about it's like, well, if the IRS knows how much I made, what do I have to do all this paperwork for, right? If they already know the number, right? And the answer is they don't know the number. In fact, if you do what I did, so the reason I started getting those letters back in '07 was because if you go several years without filing a tax return, the IRS will file. It's not an actual tax return; they call it a substitute for return. They will take whatever information they have on you and they'll do a tax calculation. And if at the end of that calculation you owe money or they think you would have owed money, then you'll get a letter. And that's where those things are generated. If at the end of that calculation they decide you probably would have gotten a refund, you'll never hear from them. So in my case, they thought I owed $1.3 million. But when they do those substitute for returns, they do it in the way that is the least favorable to you. And that's not an accident, right? So when people talk about it's like, oh, this whole system is redundant, it's like, well, not really. $100 shows up in your bank account. Like, what is that? Well, I don't know. It depends. It might be income. It might be a gift. It might be a loan payback. It might be loan proceeds. It could be all different kinds of things. And when you file your taxes, you're telling the IRS and whatever state agencies what actually happened with the money in your life, as far as how much of it is taxable and how much of it isn't. And it's up to you to do that in a way that is both accurate, and it is, I would say, an obligation on your part to do it accurate and in a framing that is as favorable as possible to you.
Now, that doesn't really hold as true with a W-2 employee, right? Because they do have an accurate assessment of what the person received if you have no other income outside of a W-2.
If you have a W-2 only and that's all you have going on in your life, then yeah, that would be correct. But even then, you go out to dinner and somebody Venmos you $100. Is that $100 income? I don't know.
Good point. Good point. So last time we had you on, we talked about Kamala. We talked about the unrealized tax gains. Thank goodness none of that came to fruition. But between both her election and the tax plan that was floating around there in the ethos, or in the ethers, I mean. But now, so the big news in the world before we start talking about some individual stuff and how you can help people and why they need you, let's chat about what's going on in the world.
Yeah. So, funnily enough, Australia has started going down the path of the unrealized capital gains taxes. I think it was last week or the week before there were some announcements about that. But fortunately, that is dead for now in the U.S. That whole idea, and it would be unconstitutional in the U.S. in my opinion, anyway. But that's not necessarily going to stop them. Right now, we have the big beautiful bill, which is the Trump tax package 2.0. One version of the bill has passed the House and it is now in the Senate, and they're doing their negotiations. And so, just the regular legislative process, if the Senate makes changes, which they're going to, then it has to go back and they have to reconcile the bill to make sure they can pass a version that is for both the House and the Senate. So we don't know what the final exact language is going to be because there will be changes, but we have kind of a framework at this point and details to be decided. So the major things are that, for the most part, Tax Cut and Jobs Act, which was Trump's 1.0 tax reform back in 2017, is going to be made permanent. So when Tax Cut and Jobs Act was originally passed, it was passed in a way that had a 10-year window. And those 10 years are almost up. And it just so happens that because, Biden got in and then Trump is in again, he happens to be president again at the end of the 10 years, as well as the beginning of the 10 years, which is, historically unusual, obviously. But yeah, so they're going to remove the time limits on the original Tax Cut and Jobs Act for most things. For the older people in the audience, you might remember there were these things called exemptions. Those have been gone for since 2017, and will continue to be gone so forever. So we used to have a smaller standard deduction, and then we had exemptions based on the number of people in your tax household. So now we just have the single larger standard deduction, and that's going to continue from here on out. Other provisions, the qualified business income deduction, which is the tax break for people who have qualified business incomes, like pass-throughs for sole proprietorships or S corps or partnerships or real estate, things like that. That's going to continue. They're talking about increasing the rate at which you get that break from 20% to 23%. That's the max. So that's potentially interesting. A whole lot of things that we used to have in the old days that were eliminated in Tax Cut and Jobs Act is going to still be eliminated. So like we used to get moving expenses as a deduction federally. We used to get unreimbursed employee expenses. So when people say, it's like, oh, yeah, I have a job, I have a W 2, but I work from home, so I have a home office. No, you don't. That only works if you have your own business. It doesn't work if you're a W 2 because that's an unreimbursed employee expense, which are no longer deducted.
So things like that will be able to be deducted again, you're saying?
No, so so those were eliminated by Tax Cut and Jobs Act, and that elimination will continue, basically.
Okay.
So like in the old days, if your house, if a pipe sprung a leak and you had $20,000 worth of damages, in the old days you could deduct that as a casualty loss. Now and continuing, you can only deduct that if you are also in a federally declared disaster, like a hurricane or an earthquake or something like that. A lot of these tweaks are just being made permanent. And then there's these other things that are being introduced. So the no tax on tips, no tax on overtime. The no tax on Social Security did not make it into the current version of the language that we have. Instead, what they did was they added a $4,000 deduction for seniors. The no tax on tips thing was interesting. So in the big, beautiful bill, there's a provision that says no tax on tips and then lays out all the ways in which there are no taxes on tips. And basically, there's going to be an additional deduction above your standard deduction. So if you're a waiter at a fancy place, let's say you make 80 grand for the year, 20 in salary and 60 in tips, then you'll be able to deduct that full 60,000 from your income, and you'll only pay tax on 20, which is virtually nothing. So when they first started talking about this, I had noted that there has been a bill that's been introduced every year into the Congress for doing that same thing. And I assumed that they would just take that language and just stuff it into the big bill, which is kind of what they usually do. But in actual fact, that's not what they did. They wrote their own version. And then after the House passed their version of the Big Beautiful Bill, the Senate passed the No Tax on Tips bill as a separate bill. Now, there are differences between the two, though. So the Big Beautiful Bill had unlimited deductions for tips, and then that went to the Senate. The Senate version had a limit of 25,000, and that has now gone to the House. And so, there's been a lot of back and forth about, if the negotiations fail in the Senate as far as the Big Beautiful Bill, maybe they'll use this carve out kind of approach where it's like, okay, these uncontroversial things that we think we can get passed, we'll just pass those individually, and then whatever's left over, we'll put into the big bill. But it's just a circus, basically.
Does this mean if either one of those pass that everywhere I go, they're gonna hound me even harder for tips
100%.
for every
Yes.
single thing I do, every service I get? The worst one, just to go off on a tangent, is when I'll stop at Panera Bread once in a while, and all they do is hand you a cup. And at one time they had the little spinning iPad. Like now it's just the stationary one in front of you. But at one time they had that spinning iPad, and I remember like the cup was next to it, and she handed me a cup on the iPad for a tip, and I was like, I gotta get my own coffee over there.
Yeah. And I love it when it's like, oh, the system's going to ask you a question. I have nothing to do with it, but it's there.
I like that. Yeah, it's gonna ask you a question. And then I like when like there's 4 buttons and it gives you 3 options, like 10, 15, 20%, and other. So to hit 0, I have to go into the second page of the menu to choose it. And so that they watch you hitting all these buttons. Now they know you're not tipping them for handing you a napkin.
Yeah.
And if you look at the numbers on that, if you look at the sales pitch for, Square and Stripe and all these businesses that implement that, it works because people are going to default to the easiest thing. And if you set your lowest option to 15%, and now where you become conditioned to, like you go, it used to be you get a good meal, good service, 20% tip. That's reasonable. It's like 20% of your total expenditure. And most people are doing it on the total amount after taxes. So like we're already over tipping. But now you like Brian said, you pour your own coffee or you get a donut and you're still paying 20% because that's the lowest option they give you. The percent increase that those machines generate for shops is astronomical.
Yeah.
And
Yeah.
I don't think economically there's really a justification for, like, if we assume the IRS's premise, if we assume all of their givens about what income is and how to get around it, economically not taxing tips doesn't make sense. Though it is a great soundbite, it is a great political, headline. If a waiter's making 80% of their income via tips or 40%, like that is their income. It's just in a different form. I feel like we should just get rid of tipping, and like Japan does. It's way better over in Japan when you just pay the price you see. But that's not going to happen.
We do accept tips. We have Venmo. We have ways that you can tip us.
Yeah.
If you want to just have some tax-free income, I'm happy to take it.
So the devil is in the details when it comes to tips. So you have to be in an industry that is historically known to have tips. There's got to be voluntary. There can't be any coercive element, or it can't be, oh, if you don't tip me, I can't do the thing. That can't be part of it. They're supposedly, assuming one version or the other passes, they're going to come out with a list of business types that are allowable for tips. But it actually does create a problem, at least for those businesses, because up until now, especially if you're a self-employed hairdresser, I've got a number of clients that do hair just on their own. They go to clients' houses or they work out of their basement or whatever. They're just recording revenue. But now you've got to go back and fix all your records saying, okay, how much was tip and how much was service income. So, there's definitely issues that go along with it. But yeah, I mean, to your point, Hans, there is no logic as to why this would be treated specially. It's just it's a reward for this voting block. It's just based on campaigning. People ask me all the time, it's like, well, why is the taxes this way for this thing? And why is it that way for that thing? It's like, there is no reason. It's just because Congress says so. That's all of taxes.
There's also in the big beautiful bill, which is hard to say without laughing because it's so preposterous. Like
the BBL,
we're just gonna we're beating the shit out of you with a bag of nickels every single day of your life, but we're gonna remove 2 nickels. We'll put in a dime, even though it's a little bit less weight, but the amount of coins, it's this big beautiful way to keep beating you. I mean, the whole idea is frustrating. But for the big beautiful bill, there's the child tax credit. There's some changes to that. There's the U.S. made vehicle, and then the SALT cap. If you can talk about what those are and what those will likely mean for listeners.
Pretty much anybody who has children, almost anybody, unless you're very high income, gets a credit for children under the age of 17, and it's just a tax credit that just gets calculated.
Unless you don't have a Social Security for them, which is my current situation.
For almost all these provisions, you have to have a Social Security number, which is interesting because prior to this, if you were an ITIN holder, you would apply for a number from the IRS and say, hey, ITIN is Individual Taxpayer Identification Number. It looks exactly like a Social Security number, but it starts with the number 9 instead of 0 through 8. And these are for non-citizens who need a tax identification number for whatever purpose. And so historically, most provisions applied equally to ITIN holders and Social Security number holders. And almost every provision that I've looked at in the BBL specifies it has to be a Social Security number that in order to get this benefit. So the child tax credit is one that's pretty much everybody who has kids gets, and it's the numbers have changed over the years. So child tax credit is interesting because it can be non-refundable or refundable depending on your income situation. And the numbers have changed over the years. So it used to be 1,000, and then it was up to 3,600. During the lockdown period, people were getting direct deposits, a lot of people, for like $300 a month per kid. And there were different numbers if they were under 6 or under 17 or whatever. So right now, it's looking like they're going to raise the max credit for the child tax credit up to potentially $3,600. So, that will be subject to negotiation. We'll see where that ends up. But that seems pretty likely that number is going to get increased.
Have more kids, people.
Oh, well, that's part of the thing. There's also the MAGA accounts, which we should circle back at some point. So there's that. The deduction for cars, they have to at least be assembled in America in order to qualify. And the interest you would pay on buying one of these cars would be deductible up to $10,000.
$10,000 on the price of the car, or $10,000 in interest?
Interest. Yeah, and it doesn't work for leases. You have to actually purchase the car.
You have to purchase by financing it.
Yeah. Well, there's no interest if you don't.
Oh, okay. I thought it was on the purchase price because we're going to get a new car by the end of the year. And I actually asked you, our Toyota Sequoia is built in America, and I think they are. So I was like, oh, sweet, I'll get 10,000 deduction there, but not if we do a policy loan and purchase it in cash at the dealer and take the note ourselves.
Yeah, and at that point, maybe it's worth
Bag of nickels.
maybe it's so. This is the weird distortions that get introduced. It's like, well, under that scenario, let's assume everything passes as is. Is it worth getting the financing and then taking the policy loan to pay the financing in order to book the interest in order to get the deduction? Maybe.
It could all just like this is the thing with taxes. Like it could just not be. Like there could be a flat tax where consumption drives what you contribute, but there's so much of this stuff where it could just not be. Instead of needing to spend a whole career dedicated to the ins and outs of this thing, that could just not exist.
Yep.
Which I'm glad people like you are willing to do this.
Yeah.
It just drives me bonkers trying to navigate this thing.
Yeah. Well, I've spent basically my whole adult life fixing government problems. So I used to help kids going through government schools actually learn stuff and pass tests. So fixing the problems with there, and then I moved into the tax world, helping people fix the interactions with government through their businesses and personal finances and everything. So, yeah, I mean, if the government were just not intrusive and did what they said they were going to do well, I wouldn't have a career. So there's that.
On the IBC front, with what we were just talking about, could somebody get creative and create like for me, like Brian Moody Financing LLC, policy loan to the LLC,
Yeah.
and then write the loan to Brian Moody, the person,
Yeah.
for that vehicle?
Potentially, I'd have to think about that. So, I mean, insurance companies do provide lines of credit to finance companies. So that's not an unusual arrangement. It's whether you are, if you're like both sides of the thing, does that still work? I'd have to think about.
That's where a cash value line of credit could come in handy. Would that?
Yeah.
Or is that just adding another?
Yeah, maybe.
It's so stupid.
If and when the bill gets passed, you got to go into. It's like a lot of times it'll have language like, and the secretary of so and so will publish a list within 90 days of things that qualify and stuff like that. So you got to wait for those and then figure out, okay, based on that, what can we do? So if you started a company that used your policy to finance other people's purchases, I would say, that would definitely work. But financing your own, I'd have to look at the details, and obviously none of this matters until bill actually gets passed. But yeah, so I mean, it introduces all kinds of shenanigans that could potentially be played. So yeah, so that's the car interest one. Hans, you said the SALT cap. SALT stands for state and local taxes. So if you open up your Schedule A on your tax return, if you have one, that's the itemized deductions. So basic primer, you calculate your itemized deductions, which are the allowed deductions for a personal 1040. Certain categories are allowed to reduce your income. If that number at the end of that schedule is greater than your standard deduction, then you take the itemized. If it's less, then you just take the standard because that's bigger, right? SALT is part of that. So that's the taxes you pay for state income taxes, local income taxes, local property taxes, stuff like that. And before Tax Cut and Jobs Act, that was unlimited. So if you were a high income person in a high tax state, just working on somebody's file where they live in New Jersey, and they pay 20 grand a year in property taxes for a kind of normal house, right? Just because New Jersey has the highest property taxes in the country. In the old days, that deduction was unlimited. So if you paid $20,000 in property taxes and another $10,000 in state income taxes, well, you got a $30,000 deduction on your itemized deductions. And that was generally enough to exceed your standard deduction, and it would reduce your taxable income and reduce your taxes. Okay. So Tax Cut and Jobs Act comes along and say, okay, SALT taxes are limited to $10,000. If you paid $20,000 in property taxes and $10,000 in income taxes to New Jersey, then the deduction that you get for federal purposes is still $10,000 because that's the cap. And so what it did was it, paid for, quote unquote, paid for a lot of other tax cuts by punishing people in high tax areas. Now, as it happens, those high tax areas tend to vote Democrat. So politically, you have to admire the strategy of like, okay, we're going to stick it to Democrats in order to pay for our tax cuts to our Republican friends. Well, that's, in effect what happened. So, but ever since then, people have been upset, right? And understandable. So if you used to get this huge deduction and that got wiped out, I would be mad too. I would say don't live there, but that's just me.
Well, yeah, out here in California, the land of fruits and gays. We're paying 13% on income tax. That's higher than some people pay in federal, but everyone's paying that out here. It's insane.
Yeah. Well, California does have brackets, so but you go through those brackets pretty quick. So now the current negotiation is, where are we going to adjust this cap on salt and for whom? Right. So the latest thing this morning was that, okay, for filers who make less than 400,000, we're going to raise the cap from 10,000 to 20,000. And there have been all kinds of different proposals floated from the Congress, but that's the latest one that I've heard this morning. And, again, we'll see where it comes down in an actual piece of legislation that is passed, but it's almost certainly going to stay in some form, because eliminating the cap would, quote unquote, cost the government too much, in that, that would allow more people to keep their own money. So, they need to, they do these budget scorings from the Congressional Budget Office, CBO. They publish these reports and they say, okay, if based on our assumptions of the future 10 years, if we implement this particular piece of legislation, the effect on the debt and the deficit is going to be XYZ. And so you've probably seen these headlines over the last week or two saying that, oh, it's going to add $3 trillion to the debt. Like, well, maybe, right? I've never seen a CBO projection be right, ever, about anything. But, but based on their assumptions, and if you plug in the numbers into their model, then okay.
And their assumptions include no reduction in spending.
Right. It's even economic activity from here on out. People don't really adjust their behavior. There are no recessions, all this kind of nonsense that is not real. But that's how they do their reports, and they kind of go from there. But in those reports, they say, okay, the measures in this bill, some of them will raise money and some of them will cost money. And again, cost is in terms of less tax money coming into the government. When they do all that, politically, it is advantageous for the Republicans to put in these measures that will offset some of the cuts with increases, so that the net budget score is not as bad. And again, as bad as from the government perspective. That's where the sticking point of that negotiation comes in. And then, a lot of people, both Republicans and Democrats, don't want to see high income people in high tax areas get a benefit that would be, special pleading for fat cats, basically. So that's been an issue with the Democrats on that side.
I don't dislike the idea of Democrats being forced to complain about paying higher taxes. There's something poetic in that. But one thing that I want to talk about that is a huge, huge thing that everyone in the IBC community should be focusing on is the estate tax deduction sunsetting along.
Yeah.
So it seems like now, last time we talked, we didn't know that by the end of 25, this could go away and what the estate tax is. And I'll take a shot at it and you correct me where I'm wrong on this. But here's why I think it really applies for our clients and people that are practicing IBC. The estate tax is when you die, in order to pass money on to the next generation, there is a limit of how much you can do before you assume a 40% tax. Now, if your spouse is still surviving, there's an unlimited deduction. So if I die, everything that I'm worth goes to my wife untaxed for the unlimited marital deduction. But when my wife passes, before it goes to our daughters, anything over a threshold, the estate tax limit, is going to be taxed at 40%. That goes up with inflation. And that's gone up over the years. Right now, it's doubled per the TCJA. Currently, it's, I believe, 13.5 million. And for a couple, 26 million. So if I die, I pass it on to my wife without deduction or without any tax. And then when she passes, if we're worth over 26 million, now every dollar over that is taxed at 40 cents. That's the estate tax. But if the TCJA were to sunset without being extended or without these being made permanent, that amount would get cut in half. And where that matters for IBC clients like that, I personally only know one friend and client where that's a major consideration. For most of the people, like $26 million is not the ballpark that we're anywhere near or honestly really think we're ever going to get to. But if that cuts in half and we're now at the, whatever that would be, was it 6.5 right now is the single person? I mean, right now, if you are a 30-year-old officer in the military and you've gone through the process with us, you have your whole life IBC policy, and you've captured the rest of your insurability via convertible term, you're probably worth $5-6 million. And if you look at your illustrations, when you're 70, that's probably gone up to $10 million. If this estate tax limit gets cut in half and you live a long life, you are going to deal with the estate tax. And there are ways to mitigate that. It's not like you can't mitigate it, but we have to get into some more serious, either irrevocable trust. There's different ways that you can mitigate that, but you need to be thinking about it now. Whereas before, especially if it stays at 13 per person, 26 for a couple, it's not really in most of our realm of possibility. We want to get there, but can you talk about it? One, am I often in the explanation of the estate tax, the chances that it's going to stay at 13.5 and above, or continuing to grow? Any further thoughts on how we should be thinking about that if it were to cut in half? And some, like, we might be subject to that if our policies keep growing in 10, 20 years from now.
Yeah. So, I mean, your basic explanation is basically right. I mean, the numbers change year to year because of inflation adjustments. If I'm remembering correctly, the last time I looked at the big beautiful bill was they were raising it to 15 million flat, and then inflation adjusting from there. If that provision expires, then yeah, it does go back to the old limits because again, we're in this 10-year window coming to the end of it, and so yeah, that could be an issue for sure. There've been a lot of tax provisions that were created, decades ago, and just lost track with the real life inflation that we've experienced, right? So estate tax was one of them, alternative minimum tax was another, and these things were numbers that were picked 30, 40, 50 years ago, and they said, oh yeah, we'll adjust for inflation. Some of them didn't actually, but some of them did. But like the numbers that we get from official measures, they don't track quite in line with real life, and so you know let's putting it mildly, right? So, so now we're in this place where the state tax applied to virtually nobody when it was originally created now applies to more and more and more people, just as a percentage of the population, just because the numbers people are dealing with have inflated, compared to the trend line that the law is on. So yeah, that could certainly be an issue. I have this whole thing with the estate tax. So one is a lot of people consider it double taxation, which it is, because you have income that you've paid tax on, and then if that income is still in your bank account at the end and it's above some magic number, then you have to pay tax, or your estate has to pay tax on it again. So that's one element. And the other, from a practical perspective, is that it raises almost no money. So the people who it would affect pay people like me and estate attorneys and other people to make sure that it ends up not affecting them, because the fees they pay for good professional advice is far less than the tax. And so when you look at the actual government reports, like the IRS publishes a report every couple of years called tax gap analysis, and they lay out the different categories of revenue that they bring in, and the state tax is like almost nothing. So it's sort of just a lawyer and accountant support tax, because because all those people will end up doing those things like the irrevocable trust, like the charity structures and all those kinds of things in order to avoid that, because it's so egregious. And it is worth noting that some states don't follow the federal, most do, but some don't, and have their own threshold limits that are lower. So
I think that just plays on the ignorance of a large portion of the voting bloc. The mouth breathers out there who just want to see that, hey, there's somebody rich and they should get taxed, and their kids shouldn't be just trust fund babies who don't have to live the way I did and struggle. They're just going to mouth breathe continuously and never look into the fact that these people are wealthy because they've made good moves. I mean, they might not even be smarter than you, but they've made good strategic moves, and they're going to continue to do that to mitigate the effect of that. But so politically, it looks good for that voting bloc of low IQ people.
basically, I'm looking at the tax gap report from 2022. It raised 30 billion, and the IRS thinks it should have been 35. So they think billion.
Oh, billion. Yeah. I was like, if it was million, it's a total waste of time. Billion.
Yeah.
It's still not.
Can I add one? I'm going to add one piece here just to underscore my point, how comprehensive this web of taxation is, if you don't understand it. On the estate tax, going through my CLU certification, the module I'm doing now is all about taxation, life insurance, and it just makes you want to stick a screwdriver through your eye. All the caveats and ways that this thing is taxed, not the insurance is taxed, but the value of your estate is taxed. So they have what's called the generation skipping transfer tax, and so I know that when I die and it's going to go to my children, if I'm over that threshold, 40% of it's going to go to the government. And so what I could say instead is, hey, if I'm going to die and it's going to get hit by this 40% tax, anything over the threshold, what if I just leave it to my grandchildren instead, so that at least it only gets that hit once? And the IRS says, they came in and they said, hey, wait a second, you're sending it to your grandkids for the purpose of it not being taxed going to your kids and then going to their kids. It's like, yeah, of course, you idiots. Like, obviously that's what I'm trying to do. You put in this horrific, absurd double taxation, illegal way to skim more money. Yeah, of course, I'll send it to my grandkids. And they said, okay, your grandkids become a skip person. Your children are the non-skip person. Maybe I have that backwards. Your children are the non-skip person. So if I were to give my grandkids, if I were to leave them that money in my estate, they would say, wait a second, back it up. You were supposed to give it to your children. We want you to give it to your children so we can get 40% there. And then we want them, your children, to give it to their children. So we want 40% there. So if I'm using 10 million, they would say, wait a second, you can't, I give my grandchildren 10 million, IRS takes 4 million, and my grandchildren have 6. The IRS said, wait, nope, that's not right. We want more. You were supposed to, which of course, what if you don't have a good relationship with your children? It doesn't matter. Like, it's my call. Like, I can leave the money to whoever I want, but they say, no, we want you to leave it to your children. So then they would get 6 million, and then they would leave it to their children so that then the IRS would get 40% of that. And that you're going to double, you're going to essentially triple tax that. Cause like you said, the estate tax is already a double tax. So the generation skipping transfer tax, it's so unbelievable that that's allowed to happen. And it goes to Brian's point that people just don't know. People don't care. No one's reading about this stuff. And when you start reading about it, besides being, bored to tears, you also get pretty angry at how comprehensive this web is. So I say that to just to drive home the point, like the tax code is full of this kind of stuff. And if you're not aware of it, it's going to eat you alive. Like, you have to be very conscious of it.
So that's a good pivot point. Let's talk about, because I've been on both sides of this. The first thing that you can do to mitigate taxes is own a business of some sort that generates some sort of revenue. I've been a strict W-2 earner, and there's absolutely nothing you can do. You're going to be taxed at the highest rate possible as a W-2 earner. So now we move on to somebody that starts some sort of entity, some sort of business, and earns money in an entrepreneurial fashion. How can you help them? What can they do? What do you offer to somebody? And actually, let's even before that, or you know what? Let's talk about that. And then at the end, I want to talk about what it would look like if somebody calls you. If we refer somebody, like how you specifically can help them do these things you're going to talk about.
Yeah. So owning a business versus being an employee are very, very different things. So Hans, you have that book that you held up earlier with the tab. So that's the U.S. Master Tax Guide. They publish a new one of these every year. And you look at that yellow marker that he has there, that front part is just a bunch of tables. It said, if your income is this and your filing status is that, then you're going to owe this much in tax.
Yeah, gross income defined starts right.
Yeah. And so there's a whole bunch of tables saying that, okay, if your income is this, then your tax is that, right? And then after that, the whole rest of that book is all about definitions, caveats, exceptions, and all that kind of stuff. And so that comes in because there's two very different things. If you're an employee, you earn money, you are allowed a very limited number of things to deduct, maybe, and then you pay tax on that total. On a business, you earn money, you spend money on, allowable things, and most things are allowable. It's a whole conversation, but you spend money on allowable categories of thing, and then you pay tax on the remainder. So employee, you pay tax on basically the whole thing. As a business, you pay tax on what's left. So that difference in order of operations is really what makes the whole difference. When it comes to tax strategy and all the things that you can do, it's going to depend on, well, who you are fundamentally. And, I'm of the opinion that basically everybody should be in business of some kind or some fashion. Now, I know that gets a lot of pushback, and people say, it's like, well, I don't want to be a business owner. I want to just work for somebody, do my thing, and go home. It's like, okay, well, then you're going to get hit with a hammer. So that's basically the story. Because, all those exceptions and everything, it's all carrots and sticks, right? Tax code is written in a way to, one, raise revenue for the government to pay for all their spending, but also to kind of economically engineer society. So they pass tax advantages for things that they want more of, and they pass taxes for things they want less of, right? So you remember a couple of years ago there was the whole thing with the clean energy bill, which is also potentially going to be repealed with the big beautiful bill. And they wanted to encourage more solar and other alternative energy production. It said, okay, we're going to give you tax credits for this. And a whole industry spawned on the back of that for, creating companies and opportunities that comply with this particular incentive. So the government wanted more solar, they got more solar because they passed this particular bill that affected the tax situation. And so it's all carrots and sticks. The least, or I guess the most stick thing you can do is being an employee for somebody else. because not only do they get you up front, but you're also going to be paying FICA, your payroll taxes for Social Security and Medicare, and your deductions are extremely limited. Before Tax Cut and Jobs Act, there were a few more things, but it was still limited. And especially in our post Tax Cut and Jobs Act world, it's by far, business is incentivized because of the difference in order of how you earn, spend, and then pay tax. So, if people take away nothing else, I would say that's thing number one. If you have at all the emotional capability to be in business for yourself, that's going to be, the biggest advantage that you can get.
I want to highlight something you said and really put that out there. So for a W-2 employee, the order is you earn, it gets taxed in multiple ways. It gets taxed in the FICA level, it gets taxed Social Security, which part of the same thing. It gets taxed in the federal, state, local wage tax, and then you get to spend. And so what he's saying is versus that is if you are self-employed or have some sort of self-employed income, it's earned. Much of it for those things to qualify is spent, and then you're taxed on what remains. So it flips that spending and that taxing side of it, which is a huge advantage depending on how your expenses move. And I just really want to highlight that because I don't think a lot of people even think about what that means. Like, so if you're a W-2 employee, even if you can find a side gig, you can probably turn a lot of those things that you're spending on after taxes to something you're spending on before taxes.
So, for years and years, people used to complain about Amazon, about how, they make billions and trillions of dollars and they pay no tax. It's like the reason they didn't pay any tax is because they spent it all. They spent it all on improving their business, right? And so if there's any principle at all in taxation, the guiding principle for business is that if you are spending money in the pursuit of making more money, then that's okay. So that's generally going to be an allowable deduction. People will call me all the time and ask me about lawyer fees. They say, well, I paid $10,000 to this lawyer. Can I deduct that? I say, well, depends. What you paying for? If it's for your divorce, no, because that's just keeping what you already got. If you spend them on suing somebody because they didn't pay you, then yes, because that is in the pursuit of additional income. So when it comes to business structures and things like that, that's kind of a somewhat guiding principle that you can reasonably follow most of the time. I think I got enough caveats in there. But yeah, so that's job number one is, what do you have going on? How are you structured? I feel remiss if I didn't make this point that, when it comes to the W-2 side of things, so yes, you pay payroll tax, Social Security, Medicare, and or FICA, however you want to call it. And very few people recognize that as an actual tax. They just, it just kind of goes off into the ether because when you file your income taxes, the Social Security part and the Medicare part is not part of it typically, unless you switch jobs or something in the middle of the year. So that's one element. But then the other element is that, there's withholding, right? Everybody's familiar with this, that, I made $60,000 on my W-2, but I had $10,000 of withholding. So, that's the money I have already paid in to the government on behalf of my income for the year. And I always want to remind people that this started back in 1943 during World War II as, one, it was an emergency measure, right? Because they were trying to fund the war effort. And the second thing is that this was the brainchild of Milton Friedman. Mr. Free Markets was all about, taking your money away from you up front because they found that when people waited to the end of the year, they didn't pay you so much. It's a surprising thing. So that's when the current withholding system was created. And I just want to remind people of that. And, especially for your audience, they're probably more versed in the history of our monetary system than others.
Our audience certainly is most likely of the mindset that, it's your patriotic duty to pay as little in taxes as you possibly can. And one thing that's talked about a lot is the reduction in, so Biden surged the IRS numbers, which is very indicative of how he views Americans, how that administration, not him, he was just a vegetable, but, the people that faked his election and got him into office illegitimately. And he was just, sitting in a coma and someone else was doing this. But what they felt about the American people was obvious by how much they increased the workforce of the IRS. Now that's being reduced. They're doing a lot of the buyouts and offering, these severance packages to their employees, including the IRS. So I've heard kind of two things. I think it was from you on our most recent call, but they were reducing the size of the force, but then increasing AI. So is there any reason to expect less enforcement less chance of audit. I'm 90%. It had to have been you that told me this, right?
Yeah, probably. So yeah, it's hard to tell because there have been so many different headlines and stories about headcounts at the IRS. But my best guess is 30 to 50% of the workforce is gone, somewhere in there. And a lot of that, was taken from enforcement, from audits, basically. So it's an open question as far as how audits will proceed in the near future. Obviously, the next administration could always reverse course and hire more IRS agents, but for now, it looks like the audit rates will probably be lower. Now, they are trying to implement AI, but really, who knows what that means? So until we see some actual, you know, audits and some actual work that comes out of the IRS post all this stuff, we don't really know what's going to happen. There are already most notices, most letters that the IRS sends out will if you look at the top right corner of an IRS letter, it'll have like a letter code. And if it says like CP 2000 or CP 62, the CP means computer process. That means no human was involved in creating this letter. It was just some automated thing that was triggered in the IRS computers, and they sent this thing out. That's not AI, but it's already an automated process, and those things will certainly continue. Will AI be implemented in a way where they can actually make, you know, informed decisions about tax filings and things? I have no idea. You know, you guys would be more familiar with government contracting than I am, but it's like if a company is brought into the IRS to implement AI, whatever that means, like what does that turn into? It's like, well, whatever it turns into, it's probably not going to be a thing for 10 years at least, So who knows?
That's for sure. So real quick, let's do a quick walkthrough. We chatted real briefly before we were recording, and it's literally a conversation I had yesterday just to give a little idea of going back a couple minutes here. A friend of mine works for a local company. He works for his family company, and he's paid on a 1099 status, but he's just paid as an individual and pays a lot of taxes because of that, because it's not even W-2 income and he's not set up as a business. Can you give like the 5 steps of, maybe 3 steps, whatever you want to do, a short overview of like what he should be doing that would be better?
Yeah. So if you are self-employed and as a 1099 recipient, you are self-employed, regardless of how you think about it. And whether he should be a 1099 or W-2, that's a question for the labor lawyers.
Can you just explain 1099 for someone who doesn't know what that is?
So 1099 is a series of forms that gets filed at the end of the year. So a 1099 NEC, which stands for non-employment compensation, is companies saying, I paid Joe at least, I paid Joe this much during the course of the year, and here's I'm informing Joe, and here's a copy for him. I'm informing the IRS. Here's a copy for the IRS, and I'm keeping a copy of this for my records. And so, if you receive a 1099, you will often say, "I'm a 1099 contractor." There are other kinds of 1099s, but when we say I'm a 1099, that's the kind we're talking about. So the thing about receiving a 1099 is that, well, one, it's income, so you're going to have income tax associated with it, but also whatever the net earnings on that, and net is an important word there, is also subject to self-employment tax, which is the individual version of Social Security and Medicare / FICA / payroll tax. So it goes by many names, but it's all the same calculations. If you just get the 1099 and then report it as self-employment income, and that's it, then yes, you're going to pay a huge amount because you're paying whatever income tax, plus you're paying 15.3% for self-employment tax. And then the question becomes like, okay, is that the right way to go? Probably not. So, if you are self-employed, then, at least in what we do, we go through a series of steps. So like step one is we try to understand your whole situation. Are you married? Are you not? Do you have kids? Do you have real estate? Do you have investments? Do you have this, that, the other? And we try to get a general understanding of your whole situation. And then based on that, the next step is to figure out, your entities. So what should you have in order to maximize your or minimize your tax liability for the whole situation, of which the self-employment is going to be a part. And then once we have that defined, it's like, okay, once in this entity, what strategies should we apply? What can be deductions? How can we create tax-free income? How can we potentially create tax credits? All those kinds of questions become there. And then at the end, we'll talk about income optimization as far as if we need a salary or if we need profits or what have you, which is all dependent on each step depends on the one that comes before. So that's kind of the general process. So just off the top of my head, without knowing the guides, it's hard to give generalities. But if you are self-employed, in general, you should at least have an LLC to cover yourself, because that's going to limit your liability. That's what the LL in LLC is, limited liability. And if you're doing work, outside of your home, or maybe even inside your home, you want to limit the potential liability. If something happens, there's an accident or whatever, that's the legal consideration. On the tax side, once you have an LLC, you have options, because an LLC for tax purposes, for federal tax purposes, doesn't actually exist. You have to tell the IRS, I want to be treated this way or that way for tax purposes. I could be a sole proprietorship, I could be a partnership, I could be an S corporation, I could be a C corporation. And, again, depends on the situation, but usually the right answer is going to be an S corp. And then that brings in a whole other suite of options and obligations that come along with that. But that's the beginning of the planning process, and figuring out. It's like, okay, if whatever the 1099 amount is, if 60,000, 100,000, 200,000, whatever the number is, we build that in, and then we say, okay, if we do this and then we do that and we do the other thing, how can we change the tax load from being this sky high number down to something that maybe you're not happy about, but you at least feel better.
Awesome. And then that person could probably start working in some of the things that they do that are qualified expenses, because
Oh, yeah.
they're spending money to go do this job
Yep.
that could then become a tax reduction.
Definitely. If you do nothing and you just get 1099 income, you are generally going to be filing a Schedule C on your personal tax return, which is, you were asking about audits earlier. So it's debatable at this point, but in the past, that has been the highest audit risk way to have income. And the reason for that is because you're in the cohort of people who aren't managing their taxes, and then get into they get into TurboTax or whatever software they're using, and they say, oh, I owe this giant amount of money, let's put in some other stuff over here that lowers that amount. And so basically the self-prepared Schedule Cs have a huge rate of fraud, and the IRS knows this, right? So they audit them at a higher rate. So by shifting it to a different tax entity, you can reduce your risk of audit just overall, just by making that one change, which I'm a fan of in general. Obviously, there are other costs associated with it, but generally worth it.
We've got several of our clients that have formed an entity and have started working with you, and all of them across the board have reported very positive results. And I can say the same thing for myself. So if someone wants to get started with you, what's just a brief overview of your process? How do you approach the calls, and what might it cost someone? I know that's specific to the individual, but what's a brief overview of your situation?
So the easiest thing is you go to just taxsherpa.com, and then up at the top link, or at the up top bar, there's a book a call, and you can talk to one of our tax experts, and we'll go over that process of determining what your situation is. The first talk is just gathering all that information, so that and everybody's situation is different. We just talked to somebody last week who hasn't filed taxes in 4 years, but has this huge bill that she thinks she owes, and she's probably going to owe some of it. And so that's the fact finding part of the job. And then we come back as a team and we talk about it, amongst the group, and then we figure out, okay, what strategies can we apply? This person has real estate, this person did this, that, the other. So how can we fit this together? And then we'll have a follow-up call, kind of going over the basic options. And it's like, okay, based on what you're telling us and the numbers that you've given us, we think we can do X, Y, and Z, and we think we can save you 10,000, 20,000, whatever the number is. Sometimes it's a huge number. Sometimes it's a smaller number. Just depends on the situation. And from there, we figure out what's the best way to engage. So at the lowest level, obviously we can just file tax returns, right? And that's just going to be depending on how complex your filings are, is going to be just a flat rate. At the highest level, we have people who actively we work with throughout the year to not only plan the taxes for the year, but also implement that plan and update them throughout the year. And so that's obviously going to be a higher engagement. It's going to be much more work involved on all of our parts. Some people think like, well, I'm hiring you, so you do everything. It's like, well, we still need you to participate. So that's kind of like the two ends of the spectrum. And there are some in the middle options where I've created like DIY type materials and calculators and spreadsheets for the people who really just need the guidance and then can do it all themselves. That tends to be fairly rare, but that is an option. Most people need not only the guidance but also the implementation for us to do all that. But yeah, so the numbers vary. It might be a few $100 for a tax return. It might be many thousands a month, depending on what level of involvement that we need to be with that particular client. So it's hard to give one number, but that's kind of the range.
And if somebody comes in that has had an inferior tax planning or tax service in the
Yep.
past, will you give them a look back and try to help them with
Yep.
previously poorly planned?
Some things are fixable, some things are not, but we will definitely give it a review. And if there is something to fix, then it's just regular tax work at that point, as far as just filing returns. But a lot of times we end up in the situation where we'll look at last year's and says, well, you did this, and if we had been there, we would have done X, Y, Z, and it would have been this much less. But at this point, we can't actually change anything. But going forward, we can make those same similar type of decisions and save going forward. I used to, back in the old days, I used to give hard numbers to people. And I had this one woman, she came into my office. She was a home health aide, and she worked for like, I don't know, 5 or 6 different places, which was fairly common in that industry, different agencies that she worked for. And she, when everything was cobbled together, she made a good bit of money, and she was all 1099. And, so, we set her up with her own LLC and, did all these things and drastically lowered her taxes. And I had told her, it's like, well, how long have you been doing this? And she said she'd been doing this job for 8 years. I said, well, if we had seen you 8 years ago, we would have saved you. I forget what the number was. It's like $40,000 or $50,000 over that time. And she just started crying in my office. So I was like, I'm not gonna put such a fine point on it for people. I don't think anymore. But yeah, we definitely do review past tax returns and try to highlight issues. If there's fixable errors, we will definitely fix them. I was talking to a client a couple weeks ago. She runs a jewelry store, and I'm looking at her books, and it's got certain numbers on it. I'm looking at the tax return. Some of the numbers are the same, but some of them are different. Like, where did this number come from? She says, I don't know. I said, okay, well, we need to figure out what's going on. And so we're still in the process of figuring out where the tax preparer got this particular number that added $100,000 worth of income to her bottom line, and then caused her to owe, a large amount of money. We do definitely review the past to figure out what is going on and what needs to be fixed or what can be done better going forward.
I also want to point out that as far as to give you a shout out for our audience and anybody that may come across this, like Neil practices infinite banking. He's very, very familiar with the concept. I've often heard the question through our industry is like, does anybody know an accountant or does anybody know somebody that understands IBC? Because most people, most of the time they'll just tell them, put your money here, save on taxes now. The whole thing that we always hear in standard financial planning and standard tax planning services. So Neil understands it. If you're an IBC company out there, I suggest you give him a call. If you're a similarly situated company, you're listening to our podcast, call Neil. He understands what we do. He understands what you do. He does it. So it's a really easy fit within our industry, and it's awesome. So when I first met you, I forget a number of years ago now, yeah, you were like, yeah, I do IBC. I do IBC. You know what I mean? And then you were getting your stuff rolling, and I was just like, well, this is such an easy fit because that was one of the problems was you could never find an accountant who understood our industry. So huge shout out there for anybody that listens and any other businesses that listen, man, give them a call. It's awesome to work with somebody on the tax side who understands what we're doing in the whole life space.
Yeah, I'm a fan. And in fact, one of the typical strategies you'll hear from your traditional finance person or traditional tax person is like, oh, you put money into an IRA or a 401k. And, that does work. It does defer taxes. It doesn't avoid taxes, but it defers them. And, when I talk to, especially when I talk to people who I know are in the IBC world, is like, well, do you want to contribute to retirement? Because if you don't, then we can just ignore this part. But, it's, but I like to make the option available because some people do both actually, and have enough cash flow to make it work. And then the question becomes like, well, how do I pay for stuff? Do I take a policy loan in order to fund a retirement plan? And it's like, well, the numbers can work. If you're paying, I forget what interest rates are now, like 6%, 6.5%. If you're paying whatever the interest cost is on the policy loan, in order to get, if you're in a higher bracket, a 35 or 40% tax deduction, then maybe it makes sense. It's very personal. It's very subjective, and so I just like to make people aware. And at the same time, I'm not going to criticize people for the choice of whether they do or don't want to contribute to traditional finance plans. But we'll just go through the options and you make your own decisions.
Well, we'll put the link to book a call with you. My final thought and I guess plea for the audience is, we have some calculators, some software where you can input a lot of different variables and see projections. And one exercise that helps people understand the time value of money and what expenses can do when you're looking at a portfolio growth is, if you take a 30-year projection, you can dial the interest rate to whatever you want. And you see in 30 years, I'll have, this will be $3 million. Once we add a 1% expense fee on there, which is very standard assets under management, we add that 1%. Over 30 years, you're going to lose anywhere from 25 to 30% of that projected value with 1% assets under management fee. What are we paying in taxes? Double digits. Yeah. 10 if you're making no money, 30, 40, depending on where you live, depending on how much money you make. 1% assets under management fee can destroy a third of your wealth on that projected timeline. However you want to set the assumptions of how it's going to grow, you're giving it up, whether market's going up or down that 1%. What can 30% do to your wealth? And if you're not thinking about this and you don't have a strategy at all, and your only strategy is to look back and have someone file your taxes with a retroactive, here's what happened last year, we're not going to change anything, and here's our number today, without any kind of planning for the future or putting these things in place now. I mean, I went from being a TurboTax filer to now I have entities you guys helped me set up. We retroactively set them up for the previous year. Exactly. Like all of these things that I had no idea, we have to go through. And like, if you don't know what you're doing, you need help with this. Like, this is not something that you're just going to master on your own. And so please give Neil a call. If everything we said today, if there's a single piece that didn't make sense to you, it's worth exploring. You should pull every thread and make sure that you've got this thing buttoned up, because they have a plan for you and it is suffocating. That's all I got.
Yeah. And I will say on my end of it, without even talking about what the fee is, but the fee it's worth it. I mean, what you pay to get good tax advice and keep more money in your life is worth every penny.
We always want our clients to be in a positive situation. So whatever we cost, we will save you, multiples of that.
Yeah, can confirm. All right, y'all, you got anything else?
No, man, just check out Neil at Tax Sherpa. Like Han said, we'll link to that in the show notes. And please like, subscribe, share this, and give him a call. I promise it'll be worth at least an exploratory discussion, especially if you're a business owner.
All right. Cheers, y'all.
See you.